In this video, we will walk through the steps in this Exam 2 study guide on page 2, where we talk about the three financial statements: income, balance, consolidated cash flows. We will then go through the free cash flow calculation and the discounted cash flow. And we'll be doing this with a file provided called Practice1 for the full pro forma model Practice1. I'm going to turn off the sound and work through the 4-quadrant model relatively quickly. You can look at the solution if you have any questions about it. Now that we've worked through that 4-step method, we see a lot of errors in here, but that's because we don't have balance sheet items yet. So I'll turn the sound off again and do the same thing. I'll begin with the 4-step method on current assets, current liabilities, and net fixed assets. But I wanted to draw your attention to the fact in this model I added a line for SG&A, and it works just like cost of goods sold or depreciation or taxes or any of these other things that decrease our net income. Also changed the way we were calculating this ratio. I'd mentioned in class several times that depreciation as a percent of fixed assets or net fixed assets either can be justified. I kind of like the net fixed assets better, and that's how I happen to design this practice problem. So moving on to the 4-step method. Let's go back to the study guide and see what we've done so far. We have begun with the income statement and used our 4-quadrant method. We only had one line for shares, so we're not concerned about basic or diluted. On the balance sheet, very next thing we'll do is refer to the bottom of the consolidated statement of cash flows to get our cash. And then we've already used the 4-quadrant method for current assets and liabilities, as well as net fixed assets. There's a whole section on the previous page of the study guide talking about this. I strongly encourage you to review that. So our next step, we said, was to grab the cash from the bottom of the ending cash balance sheet. And since ending cash balance, since that is calculated as the ending cash balance of the year 2019, then that's the number that we need to put up there. It would be tempting to pick the prior year and kind of carry it forward, but that's not what we're doing. We're saying if we began with some balance in the prior year, made all these net increases, then what did we end up with? And that's what belongs here on the balance sheet. Of course, it's 0 right now because we haven't done the statement of cash flows. And as we reviewed that fixed assets portion on the previous page of the study guide, we saw that net fixed assets, if that's what we are forecasting, then we can get accumulated depreciation from the balance sheet, from the income statement to continue to accumulate. And then we know that at cost, fixed assets must be the difference in those two, which in this case means this minus a negative. And then our total assets include cash and current assets. They don't include these two intermediate lines, only the net of those two lines. We're told in the problem to simply carry our stock and debt forward to hold it flat, so we'll do that. And then we know that accumulated retained earnings also accumulate from the income statement. And every line item here can be added into total liabilities and equity. And we see that we're out of balance on the balance sheet. That's because we don't have any cash. So if we carry all those formulas forward, then when we get our cash correct, hopefully these come into balance. Let's see. We know that we begin with the profit after tax from the income statement. We want to add back depreciation. This is something that made profit after tax look smaller than it really would be on a cash basis. And since depreciation has a negative sign here, we'll reverse the sign with a negative sign there. And then if any of our working capital assets increased, that was a use of cash, so we want to subtract that. And if any of our current liabilities increased, that was actually a source of cash for us, so we want to include that. And similar to the current assets, if the fixed assets at cost increased, we want to subtract that change off. And carry that forward to the summary line. And if we issued any debt, we would want that generated cash to be reflected. And the same for the stock. I think I can copy that formula down, hit F2, make sure I'm looking at stock. And then we want to take off any dividends that we paid. We know they show up as negative already, so we can just refer to that cell with no negative sign and then sum all of that. We copy that and carry it forward. Let's get the other two lines here. If we know the cash we began with, and we know the total net changes that we just calculated above, then we know the cash we should end with. Do Control R to copy that across and go see if our balance sheet balances, and it does. And I don't think I did a very good job of following along with these bullets, but I think if you read those bullets, you'll see that what we did lines up pretty well with them. Now we're ready to do our free cash flow calculation. It's essentially the same thing we've done, and you'll notice in this model that I've kind of rephrased these line items to look exactly like the line items above where we had the same things. We'd use a little bit different wording on some of those and didn't have the positive and negative signs. But since you're doing the same exact thing again, I wanted you to be able to see it the same way. To calculate our after-tax interest on debt, we need to know our tax rate. Normally we would get that after-tax factor by saying 1 minus the tax rate. But since we were quick and calculated our effective tax rate as a negative, I'm going to say 1 plus this negative, what was that number? Negative 27%. And multiply that by the, are we calculating interest paid on debt? And then we're immediately going to turn around and do this for interest earned on cash and marketable securities on line 14. But since that was negative in C13, then I need to add a negative sign here. We can copy that entire formula here and look at C14. And we actually do want to subtract a positive number, so we still need that negative sign. If we sum all those up, we should see what our free cash flow was for that year. Checking the solution, I see that I forgot to put in the profit after tax. So let me grab that. adjust my sum, and that should be the correct cash flow. We've now integrated all three statements, and we've calculated free cash flow from those statements. So we're ready to begin where we did in quiz 4 to do the DCF valuation. In quiz 4 we were given a WACC, but here we need to calculate it. We already know that that tax rate is available up here as a ratio because we used it a minute ago. And the cost of debt also is available as a ratio. That was our payments divided by our average debt, but I need a negative sign to get it correct. And the debt itself is on the balance sheet because we can use book value of debt for this purpose. We don't know the cost of equity, but fortunately it was given in the problem, as was the equity value, the market value of the equity. And with those items, we can use our WACC formula, which has been adjusted from quiz 4. Quiz 4 didn't have before tax, it had after tax cost of debt. So we'll say it that way. Regardless, you know the formula for WACC. We're also given an assumption for long-term free cash flow growth rate. And we're given an exit multiple for free cash flow. In practice, it's probably more common to use a earnings multiple, but we're going to do it off free cash flow. It certainly gets the concept across more easily. And then we'll go through our terminal value calculations just like we did on quiz 4. And now we have an equity value per share calculated using the perpetual growth assumptions. Let's see what it would be using the multiples assumptions. But first, let me see how many of these numbers I can pull across, or at least formulas. So the PV of the cash flows is the same for either method. This formula to sum is the same. Cash is the same. Debt is the same. This formula to sum is the same, and shares are the same. This formula to divide is the same. And now all I need to do is calculate the terminal value, its present value, and the implied multiple. And the model is complete. I sped through a lot of that, but it took me 25 minutes in real time to do it. Hopefully you can do it that quickly on the exam.